Okay, in this video, we're going to go through the lease disclosure. So how are leases, operating and finance leases, disclosed in companies' financial statements? And this has to do entirely with the post-2019 treatment of leases. So there are two categories of leases, operating and finance leases. Before 2019, there was operating and capital leases. This is post-2019 disclosure of leases, and we're going to use Target. So let's take a look at Target. I'll just move out of the way for a minute here. So take a look at Target's consolidated statement of financial position, which is their balance sheet. So I don't know why Target can't just use the word balance sheet. I don't know what's so hard about it. Everybody else calls it a balance sheet. Well, most companies call it a balance sheet. I don't know what their problem is. But here it is. They've got assets, liabilities, and equity down here. Okay, so here in their balance sheet is reported February 2nd, 2019, February 3rd, 2018 as adjusted. Okay, and the reason it's as adjusted is that Target, so I showed you in a previous video companies that adopted the lease standard, and they adopted it in a prospective fashion. And prospective means you leave your former financial statements alone. You just put the asset and liability on your financial statements now. Well, Target and other companies used a retroactive or retrospective adoption of the lease standard. And that means they restate previously issued financial statements to comply with the new standard. So let's take a look at Target's balance sheet. They've got operating lease assets here. And they've got it for 2019 and 2018. So they did a retrospective or retroactive adoption of the lease standard. That's why you see lease assets in both years. And let me get my laser pointer. That's why you see lease assets in both years, 2018 and 2019. Okay, and so these are the operating lease assets. I believe they keep their capital lease assets probably just in the property, plant, and equipment balance. So all of their capital lease assets are in this property, plant, and equipment balances. And then if you turn to the liabilities section, so it's not really clear where all of it is held. In terms of current lease obligations, it turns out to be held in two accounts. So they keep their operating lease obligations in this accrued and other current liabilities caption. They keep their capital lease obligations, or finance lease obligations. Finance lease is the new term. Finance lease obligations are kept in the current portion of long-term debt and other borrowings. In terms of the non-current section, long-term debt and other borrowings, long-term, that's where they keep their long-term capital lease, finance lease obligations. And here they have a separate line item for non-current operating lease liability. So that's their operating lease obligations. Okay, so there's where the leased assets and leased liabilities appear on the balance sheet. If you ask me, it's a little confusing. I don't know why they just don't have a single line item for it, but they want to continue to separate out operating leases from finance leases. And now let me show you the footnote for leases that Target presents. And it's a great informative footnote. So take a look at the first part of it. So this is footnote 18 for Target. And they break down the balance sheet amounts relating to leases. So they give you the type of lease that it is and the classification, like the label it gets on the balance sheet. And then they get you the balance. So in the asset section of the balance sheet, Target keeps its operating leases in a balance sheet label called operating lease assets. And that's for $1.9 billion. And they keep their finance leases just right in the buildings and improvements net of accumulated depreciation caption of the balance sheet. And that's $872 million. So in terms of asset value, they've got a lot more operating leases than finance leases. And in the liability section of the balance sheet, they've got current and non-current. So current operating lease liabilities are kept in accrued and other, just like we said. And current finance lease obligations are kept in the current portion of long-term debt and other borrowings. And that's just a small amount of the total lease obligation, okay? The major part of lease obligations is in non-current. So it's payments and amounts due greater than a year from this balance sheet date here, February 2nd, 2019. And so for operating leases, they have a separate caption. It's called non-current operating lease liabilities. We saw that. And that is $2 billion on the balance sheet in a liability account. For their finance leases, they keep their non-current portion right in long-term debt and other borrowings, and that's $968 million. So this is just a very clear breakdown of where the leased asset balances are kept on the balance sheet and where the lease liability balances are kept on the balance sheet, separating it out between operating and finance leases. It also shows you where the lease costs appear on the income statement. So for operating lease expenses, that's pretty simple. That's just a straight line expense over the course of the lease, okay? So it's just one element, and they keep it in SG&A expenses. So selling, general, and administrative expenses is kind of a catch-all for general and administrative expenses and selling expenses. And so it's a catch-all, and it just captures operating lease rent expense. Okay, let's just call it rent expense for operating leases. So 251 is the entire operating lease expense for the 2018 fiscal year. Finance lease costs are broken into two parts, as we know from the Finance Lease Basics video. For the asset, you are depreciating or amortizing the asset, just like you would any other asset. You're depreciating it over the lease term. And that's this, amortization of leased assets. And that goes into the depreciation and amortization line item of the income statement, and it's $65 million. The interest expense portion is on a different place in the income statement. So interest on leased liabilities, which is, again, interest expense is the effective interest method. Interest expense is equal to the beginning book value of the obligation times the effective interest rate, or the rate implicit in the lease. And that equals interest expense, this $42 million amount here. And that's kept for target in the net interest expense caption of the income statement. Now, they also do subleases on some of their leased assets, and that's revenue for them. You know, they'll get income from that. But let's just ignore that for now. That's $11 million, and we're going to ignore that. So that's where the leases appear on the balance sheet and where lease costs appear on the income statement, and they break it out between finance leases and operating leases. So it's very helpful, and it's very easy to understand how Target is accounting for their leases. Okay, and I've got some calculations, but we'll come back to those. So a little bit lower in the footnote, so this is footnote 18 continued, they break down the future cash payments that they are obligated to make under existing leases as of the end of the year 2018. As of the end of fiscal year 2018, here are the payments they're obligated to make in the future. So on operating leases, they're obligated to make $245 million of lease payments in 2019, $238 in 2020, $232 in 2021, $226 in 2022, and so on. So these are all the undiscounted operating lease payments that Target has to make in the future. Total lease payments, $2.9 billion. And if you were to discount that to today, so you subtract interest, so discount all those cash flows to today's dollars, the present value of the lease obligation is $2.170 billion. So the present value is lower because those cash payments happen in the future. So they're less painful today because they're so far into the future. That's the idea of discounting, which is this line item subtracting the interest. Okay, so that's the present value of the lease liability for operating leases, leases classified as operating. For finance leases, this is a bit smaller, isn't it? These numbers are smaller. So they're going to make cash payments of $98 million in 2019, 98 in 2020, 98 in 2021, and so on and so forth, for a total undiscounted lease payments of $1.4 billion. And when you discount those lease payments back to today, the present value of the obligation is $1.021. Okay, $1.021 billion. Okay, so this table just shows you the, they call it maturity of lease liabilities. What that means is when are we going to have to make payments on these leases? So these are the future payments that the company is obligated to make because they have signed the leases that they have. Now, I'm going to spend a little bit of time on this last part here, cash flow amounts. So in the cash flow statement, what appears in the cash flow statement? The amount of cash outflows that the company has made to pay for these leases. So they're leasing these assets, maybe from a bank or a real estate firm, and they are making payments to that bank or real estate firm to comply with the lease agreement. So you make your lease payments, your rent payments. Those payments are cash outflows, and they appear on the cash flow statement. But It depends on what type of a lease it is, where the cash flow appears on the cash flow statement. And let me tell you what I mean. So let's first talk about operating leases. That's just this first line. Operating leases are considered, you know how we consider it just rent expense on the income statement, just one type of expense? It's just rent expense. It's the cost to rent that asset. Well, it's the same for cash flow purposes. That rent expense is just an operating cash outflow. And so this $231 million cash outflow is just an operating cash outflow from operating activities, okay? So all of the cash flows are in the operating section for operating leases, okay? For finance leases, you can see it's broken out into two lines. There's some of it that goes into operating cash outflows, and some of it goes into financing cash outflows. So both of these are cash outflows, but you split up the amount of cash you're paying to these banks and real estate companies. You split it up between operating cash flows and financing cash flows, and here's how. So for operating leases, the full payment just goes into the operating cash flow section. For a finance lease, the interest cost, so the amount of interest, that's based on the implied interest rate in the lease or the effective interest rate, that interest cost goes into operating cash flows. Why is that? Well, borrowing money for, the buildings are a part of Target's operations. And so borrowing money to finance those buildings is the interest cost that the company's paying to borrow the buildings is considered an operating activity, okay? The interest cost is considered an operating activity. And if you want, you can just memorize that, okay? Maybe it doesn't make conceptual sense. It doesn't exactly, it's not obvious to me, but this is the way it works. So the interest cost goes into the operating cash flow section, whereas the principal reduction element of the cash payment goes into the financing section. And now I'm going to get a little bit more specific. So let me go back to the last slide, and I'm going to calculate the average implied effective interest rate on capital leases, okay? So let me go back to this last slide now. And what I'm going to do is I'm going to calculate the average effective interest rate on finance leases. Recall that the interest expense is equal to the effective interest rate times the beginning of period book value. So interest expense is right here, interest on lease liabilities, and this is for a finance lease. And so that's $42 million is interest expense. What is the beginning book value of the finance lease liability? Well, it's right here. It's $885 plus 80. So that's the beginning book value of the liability. And so 885 plus 80 is the beginning book value. So if you take interest expense and divide by the beginning book value, you arrive at the effective interest rate on finance leases. Okay, so 4.35% we've just calculated based on this footnote is the average effective interest rate on finance leases, 4.35%. Okay, now let's go forward and talk about the journal entry that Target's going to make. So, and this is just for finance leases. So here's the future cash payment schedule, and under finance leases, they're going to make cash payments of $98 million in 2019. So this is going to be the 2019 journal entry, and it's going to be a credit to cash of $98 million. Okay, that's in 2019. Then we calculate interest expense, and that is the 4.35% times the beginning book value. And what is the beginning book value? It's 1021. So why is 1021 the beginning book value? Well, it's the present value of the finance lease payments. So here it is, 1021, the present value of the finance lease payments. And it's the beginning book value because we're talking about 2019. So this is the beginning book value. This is the book value as of the end of 2018. And so the book value at the end of 2018 is the same as the book value at the beginning of 2019. And so beginning book value is 1021 times 4.35%, which is the average effective interest rate. And you get $44 million as interest expense. And so the debit to interest expense is $44 million. So a credit to cash of $98 million, debit to interest expense of $44 million. And so the debit, the plug here is a debit to the lease liability of 54, and that debit to the lease liability reduces the lease liability. The lease liability is a credit balance, and when you debit the account, it reduces the lease liability because we need to amortize that lease liability to zero over the lease term. And so that lease liability is amortized to zero. Because remember, leases are just like bonds, but with a face value of zero. So we're amortizing that lease liability to zero in that part of the journal entry. And here we have separated the cash outflow into two parts. The interest cost is one part of the cash outflow, and a reduction to the principal or lease liability is the other part of the cash outflow. And so that's how it's done. To allocate the interest cost is what interest expense is, and principal reduction is whatever the debit to the lease liability is. So in 2019, if no additional leases are engaged in and no leases are canceled, this is the journal entry you'll expect to see in 2019. And this is how you'll expect to see this table filled out in 2019. So it will say operating cash flows from finance leases is 44, and financing cash flows from finance leases is 54, okay? So that's what the cash flow statement will look like in 2019 if nothing changes from 2018. Okay, that's it. So I just wanted to go through this target lease disclosure with you to show you how leases are disclosed on the financial statements in the post-2019 rules environment. So I hope you enjoyed that video. Let me know if you have any questions, and I'll see you on the next video. Bye-bye.